This morning, while most Americans were still sleeping, Iran made a decision that every person in this country with a retirement account, a savings account, a mortgage, or a gas tank needs to understand right now. Egypt, Pakistan, and Turkey had spent the entire night constructing a ceasefire proposal. Pakistan's army chief was on the phone until sunrise with JD Vance, with Steve Witkoff, and with Iran's foreign minister. The proposal landed on both desks before Monday's opening bell. Iran rejected it. Tehran's foreign ministry spokesperson said on camera this morning that negotiations are incompatible with ultimatums and threats. Iran wants a permanent end to the conflict, financial reparations, and ironclad guarantees of no future attacks. The 45-day pause offered by Pakistan, Egypt, and Turkey was not enough. Tehran is holding firm. Let me say that again. Iran rejected the deal this morning. The same morning that WTI crude briefly touched $115.48 per barrel. The same morning that a United Nations international watchdog confirmed a recent strike landed just 75 meters from the perimeter of Iran's Bushehr energy facility. The same morning that the head of intelligence for Iran's Revolutionary Guard was confirmed removed in a targeted strike. The same morning that Trump's deadline of Tuesday at 8 p.m. Eastern Time is now less than 36 hours away. The same morning that the president told Fox News, if they do not make a deal fast, he is considering escalating military action significantly and securing regional energy assets. If you have money in the stock market, in a retirement account, in a savings account, or if you simply buy gasoline and groceries, what I am about to walk you through is the most important financial briefing you will hear this month. Let me start with what is actually happening on the ground, because the financial consequences only make sense once you understand the military reality underneath them. On February 28th, the United States and Israel launched a joint military operation against Iran. The Pentagon calls it Operation Epic Fury. It began as an air campaign targeting Iran's military infrastructure, defense systems, and strategic facilities. In the first 3 weeks, the campaign severely degraded the majority of Iran's conventional military capability. Precision strikes on Iran's strategic program at Isfahan, Fordow, and Natanz are believed to have set that program back by years. But here is what the air campaign could not do. It could not reopen the Strait of Hormuz. When the conflict began, Iran effectively closed the strait to commercial shipping. Daily traffic through this waterway, which normally carries roughly 20% of the world's daily oil supply, collapsed by 95%. Fewer than 100 ships have been permitted through in 6 weeks, mostly Chinese and Indian tankers. Allied shipping has been blocked almost entirely. Iran has been charging tolls of up to $12 million per passage on the vessels it does allow through. Maritime defense systems, mines, drones, and naval vessels have been staged from hardened tunnel networks on Keshem Island, the largest island in the Persian Gulf, sitting directly beside the strait. Despite 6 weeks of continuous airstrikes, Iran has kept launching aerial and projectile attacks against Gulf oil infrastructure, Saudi facilities, and Israeli cities. The blockade produced what the International Energy Agency called the greatest global energy and food security challenge in history. Oil production across the Gulf Cooperation Council, including Kuwait, Iraq, Saudi Arabia, and the UAE, dropped by at least 10 million barrels per day by mid-March. Qatar declared force majeure on all liquefied natural gas exports. And the economic shockwave from all of it is not behind us. It is accelerating. Today, Iran has rejected the ceasefire. Today, the IRGC senior intelligence official was removed in a targeted strike. Today, a strike landed 75 meters from an energy facility perimeter. The shockwave is not entering its final chapter. It is entering its most dangerous chapter. And the financial consequences of what happens in the next 36 hours will be felt by every American consumer, investor, and retiree for the rest of 2026. The disruption extends far beyond oil. The Strait of Hormuz region accounts for roughly 45% of global sulfur supply, which is essential for fertilizer production, metal processing, and industrial chemicals. Gulf countries also supply massive shares of global urea and ammonia exports. With those shipments halted, fertilizer prices are projected to roughly double from 2024 levels, and phosphate prices could increase by approximately 50%. This crisis is hitting at the worst possible time, landing directly in the Northern Hemisphere's spring planting season. Agricultural analysts warn that reduced fertilizer availability could lower yields for wheat, rice, and maize. The United Nations World Food Programme has stated that these disruptions are driving long-term increases in global food prices. The region also supplies a significant share of the world's helium, which is critical for semiconductor manufacturing. So when people tell you this is just an oil story, they are not seeing the full picture. This is an oil story, a food story, a technology supply chain story, and a global inflation story, all hitting at exactly the same moment. And it all flows through one narrow waterway that Iran has now again refused to open. The secondary effects are already landing in your daily life today. Amazon announced this morning it will apply temporary fuel surcharges to its sellers beginning April 17th. UPS, FedEx, and the U.S. Postal Service have already added fuel surcharges. United Airlines and JetBlue have raised baggage fees. Italy has been forced to limit fuel supplies at several airports. This morning's ISM Services PMI slipped to 54.0 from 56.1 in March, with the prices index rising and supplier deliveries slowing, both driven directly by oil and shipping disruption from the conflict. This is why the ceasefire rejection this morning matters so much financially. Every additional week this waterway stays closed is another week of compounding pressure on food prices, supply chains, inflation expectations, and central bank policy. And Iran just said no to the one diplomatic proposal that was on the table. The Pentagon has been weighing a deployment of up to 10,000 additional ground troops to the region. These are not support staff. They are ground forces and heavy equipment, and operational units that would join the 5,000 Marines and thousands of 82nd Airborne Division paratroopers already ordered in. If this deployment is authorized, total American ground force presence in and around Iran would exceed 50,000 personnel, the largest combat footprint since the height of the Iraq War. The primary target being discussed is Karg Island, a small coral island roughly 15 miles off the Iranian mainland. Approximately 90% of Iran's crude oil exports pass through Karg Island before tankers enter the strait. President Trump has called it Iran's crown jewel. Securing it hands the United States direct leverage over the regime's only source of revenue. A second target is Keshem Island itself, where Iran has concentrated its maritime disruption capabilities inside, those hardened tunnel networks that airstrikes have failed to neutralize. A third scenario involves a special operations mission to secure Iran's strategic materials stockpile, estimated at close to 1,000 pounds of reprocessed material. Retired Lieutenant Colonel Daniel Davis, a senior fellow at Defense Priorities, assessed the current 82nd Airborne deployment at roughly 4,000 to 5,000 operational personnel. He described that force as capable of seizing a small target for a limited time, but emphasized the 82nd Airborne is an immediate reaction force designed to hold ground while something larger arrives. The 10,000 additional personnel are that something larger. Ground forces and heavy equipment built for holding territory over weeks. The decision on whether to send them is expected this week. Now let me show you what this means for your money, because the financial markets are not waiting for the decision. They are pricing the probability right now. And the price action is telling you something most financial commentators are not willing to say directly. Oil touched 15.48 per barrel on WTI this morning, before pulling back on ceasefire hopes. Then Iran rejected the proposal. The S&P 500 has posted 5 consecutive losing weeks, the longest such streak in nearly 4 years. The Dow Jones Industrial Average dropped 469 points in a single session. The Nasdaq Composite fell 2.4% in one day and entered correction territory, sitting more than 12.5% below its all-time high. The average company inside the Nasdaq Composite is down 31% from its peak, not the index, the average company inside it. The Russell 2000 is down 10.3% from its January peak. The VIX surged 11% in a single Friday session. This is not a normal pullback. This is a market systematically repricing the probability of a prolonged conflict with cascading economic consequences. And there is a detail that reveals exactly how distorted this market has become. A Financial Times investigation found that 80 million in bets on falling oil prices were placed just 15 minutes before President Trump published his social media statement on March 23rd about postponing strikes for talks. 15 minutes. That timing triggered calls for a formal insider trading investigation. Whether or not those trades were legal, the episode tells you exactly what kind of information asymmetry is operating right now. The people closest to the decision makers are trading on signals that ordinary investors receive hours or days later. And it is not just stocks. Gold has fallen nearly 17% this month, its worst monthly performance since October of 2008, the height of the global financial crisis. The reason is counterintuitive but critical. When oil forces central banks to keep rates elevated for longer, the cost of holding gold, which pays no income, increases. Investors sell gold to raise cash. This is the same pattern from the 1973 oil crisis. Gold sold off first, then surged as the full inflationary impact worked through the economy. The pullback is not a verdict on gold. It is a snapshot of a liquidity event in progress. Now let me give you the numbers that connect the military situation directly to your household budget. Brent crude settled at $12.57 on Friday, its highest close since 2022. WTI touched 15 and 48 cents intraday this morning. When the conflict began on February 28th, Brent was around 3. That is a 54% increase in 6 weeks. The national average gasoline price reached $0.11 per gallon on Sunday, according to AAA, up from $0.98 before the conflict. In Los Angeles, some stations were posting $8.29 in late March. The OECD revised its 2026 United States inflation forecast from 2.8% to 4.2% this week. That is not a minor adjustment. That is a fundamental reassessment of the trajectory. The Federal Reserve's own March projection was 2.7%. The OECD is now forecasting inflation more than 50% higher than what the Fed projected just days earlier. And Capital Economics modeled a scenario where Brent averages 50 per barrel over the next 6 months, if the disruption extends beyond 3 months. At that level, every inflation estimate currently in print becomes a floor. Morgan Stanley estimates that for every $10 increase in oil sustained over a year, United States GDP falls by approximately 0.2%, and consumer price inflation rises by 0.3%. With oil up roughly $38 from pre-war levels on a Brent basis, that is close to 0.8% of GDP growth wiped out, and nearly 1.2% added to inflation. These are not theoretical projections. These are the mechanical consequences of energy price transmission, and they are showing up in the data released this morning. If oil averages $100 through year-end, the typical American family will pay approximately $400 more in direct energy costs this year compared to 2025. That covers gasoline, heating, and electricity. The indirect costs, higher diesel for shipping, higher natural gas for fertilizer, higher jet fuel, make the real total even larger, and the Federal Reserve is paralyzed. At its March 18th meeting, the Fed held rates at 3.5 to 3.75% and acknowledged for the first time that the Iran conflict has introduced new uncertainty into the economic outlook. Market expectations for rate cuts in 2026 have collapsed. Traders who came into this year expecting several cuts are now pricing in at best one for the entire year, with growing probability of 0. Some analysts are now openly discussing the possibility of rate hikes. A rate hike in the middle of a geopolitical crisis, with stocks in correction, oil above 10, and the government seeking $200 billion in conflict funding, would be unprecedented in modern monetary history. But the math may force it. The Fed's mandate is price stability, and if prices are destabilizing because of an energy shock, The textbook response is tighter policy, regardless of the consequences for growth. This is the textbook definition of stagflation: rising prices, combined with slowing growth and rising unemployment. The parallels to 1973 are uncomfortable. The Arab oil embargo removed about 5 million barrels per day from global supply and triggered a recession. The stock market fell 48% from peak to trough. Inflation reached 12%. Unemployment doubled. Recovery took nearly a decade. I am not saying we are heading for an exact repeat. The United States is a net energy producer. Strategic petroleum reserves exist. Alternative energy is far more developed. But the Strait of Hormuz closure represents a 10 million barrel per day supply disruption, the largest in the history of global oil markets. For comparison, the 1973 Arab oil embargo removed about 5 million barrels per day. The 1979 Iranian Revolution disrupted about 3.9 million. The current disruption is roughly double the largest previous supply shock in history. And the financial system entering this moment carries 0.6 billion in unrealized bank losses, 60 problem banks on the FDIC list, a national debt of $39 trillion growing at 7.23 billion per day, and interest payments on that debt exceeding trillion annually. The fiscal foundation has never been thinner. So what should you do? Let me be direct, because this is not a time for vague assurances about staying the course. First, understand the timeline. Trump's deadline is Tuesday at 8 p.m. Eastern Time. Iran rejected this morning's ceasefire proposal. Pakistan is the sole communication channel between Washington and Tehran. The troop deployment decision is expected this week. The combination means the next 36 hours are the highest risk window for a significant market event of the entire conflict. Monday's session will already be responding to this morning's rejection. Second, protect your liquidity. If you do not have an emergency fund covering 6 to 12 months of essential expenses, building one is your most urgent priority right now. Not in stocks, not in bonds, in cash, in an FDIC-insured high-yield savings account. The top accounts are still paying 4 to 5% APY as of this week. Varo Money is offering up to 5%. Axos Bank up to 4.21%. Newtek Bank up to 4.2%. Nationally available, FDIC insured, no fees, open online in 10 minutes. The national average savings rate is still just 0.39%, which means most Americans are leaving thousands of dollars per year on the table while inflation accelerates. On $50,000, the difference between 0.39% and 4.2% is nearly $1,000 per year. That cash fund serves two purposes. It covers your expenses if the economy deteriorates, and it gives you the ability to buy assets at lower prices if markets continue to fall. The people who had cash available during the 2020 COVID crash and the 2008 financial crisis bought quality assets at generational discounts. Cash is not just defense, it is ammunition. If you have more than $20,000 at a single bank, spread it across multiple institutions immediately. FDIC insurance covers only $20,000 per depositor, per ownership category, per institution. Everything above that limit is exposed. Third, audit your portfolio for concentration risk. If your retirement account is heavily weighted in technology stocks, you are directly exposed to the sector hardest hit during this crisis. The average company inside the NASDAQ composite is down 31% from its peak. Not the index, the average company inside it. Meta fell 8% in a single day. Nvidia dropped 4.2%. Technology stocks are priced for growth, and growth expectations contract rapidly when energy costs surge, inflation accelerates, and rate cuts disappear from the calendar. Diversifying into energy, defense, and industrial companies can help offset losses in growth-oriented positions. Morgan Stanley specifically recommended in its Iran war market analysis that investors in 2026 increase exposure around themes of defense, security, aerospace, and industrial resilience, where government spending creates multi-year demand regardless of the broader economic cycle. Fourth, Consider the inflation hedge. Gold has pulled back 17% this month, creating an entry point that did not exist in January when it was trading above 400 per ounce. The pullback is driven by forced institutional selling in a liquidity event. It is not driven by any change in the fundamental case for gold, which is stronger today than it was in January. A 5 to 15% allocation to precious metals provides insurance against exactly the scenario unfolding right now. Energy-driven inflation combined with fiscal expansion and a paralyzed Federal Reserve. Fifth, optimize your tax position. Market downturns create Roth conversion opportunities because the value of your traditional retirement assets has declined. Converting at lower values means paying less tax on the conversion and then capturing the eventual recovery inside a tax-free account. If your traditional IRA was worth $1,000 in January and is now worth $40,000 because of the market decline, converting a portion now means paying tax on the lower amount. When the market recovers, all of that growth happens inside the Roth, completely tax-free. This is the silver lining of every market downturn, but only for people who act while the window is open. Talk to a tax professional about whether a conversion makes sense for your specific situation and bracket. Let me bring this together with the bigger picture. 13 American troops have died since the conflict began on February 28th. The Strait of Hormuz has been effectively closed for 6 weeks. Oil has surged as much as 57% from pre-war levels. The S&P 500 is in its longest losing streak in 4 years. The Nasdaq average company is down 31%. Gold is having its worst month since the global financial crisis. The OECD has warned inflation will exceed 4%. The Fed is trapped. Iran has rejected the ceasefire. President Trump said this week that the United States has totally won the conflict militarily. But the markets are telling a completely different story. David Laut, chief investment officer at Crux Financial, said it directly this week. The stock market has made new 2026 lows, which suggests the market may not have yet found its bottom and is still in the process of sorting out and pricing the duration of the Middle East conflict and the oil price outlook. That is a professional money manager telling you the selling may not be finished, that the market does not yet know how to value a potential ground operation in Iran combined with $115 oil and 4% projected inflation and a paralyzed Federal Reserve. Strategists at Carson Group compiled data on 40 major geopolitical and historical events over the past 85 years and tracked S&P 500 returns in the months following each one. The pattern is consistent. Markets drop 5% to 15% around the triggering event, then recover over 6 to 12 months as the shock is absorbed and the economy adapts. The key word is adapts. And during that adaptation period, the people who held cash reserves, diversified positions, and tax-optimized accounts bought assets at lower prices. The people who held concentrated positions with no liquidity suffered drawdowns that took years to recover from. I am not telling you to panic. Panic is never a strategy. I am telling you to prepare. Panic is reactive. Preparation is proactive. Panic means selling your stocks tomorrow morning because the headlines scared you. Preparation means you have already built your cash reserve, diversified your holdings, and structured your accounts so that a downturn is an opportunity rather than a catastrophe. Build your cash reserve, diversify your holdings, audit your tech concentration. Look at the gold pullback as an entry. Have the Roth conversion conversation with a tax professional this week. And pay very close attention to what happens between now and Tuesday at 8 p.m. Eastern Time. Subscribe and turn on notifications right now. Share this with anyone who has money in the market, a retirement account, or simply fills a gas tank. Because by the time Tuesday at 8 p.m. arrives, the market will already be responding to everything I just told you.